Have you ever wondered why most traders get stopped out right before the real move happens in the market? And the market immediately reverses in your intended position just to run straight to your take profit? I know the hidden pain, tears, and frustration. Yeah, it's not even news anymore. Well, in this video, I'm revealing the secret that smart money doesn't want you to know about: liquidity, the real fuel behind every market move. And you're going to see exactly why institutional traders need liquidity to place their massive orders, and how they use retail traders' stop losses as entry points for their positions. I'll break it all down to you so simply that even a beginner can understand, and I'll show you live examples of how I follow this smart money secret and execute with precision in the market. And by the end of this video, you would understand what truly fuels and moves the market, how to avoid traps, and how to position your trades alongside institutional traders for maximum profitability. This is the kind of market knowledge they don't really want to show you. Let's dive in. Liquidity is basically, in its simplest form, market fuel. Without liquidity, the market doesn't move. And liquidity is basically just your stop loss, my stop loss, pending orders or trapped traders' positions. Buy orders, buy limits, sell limits, buy stops, sell stops, stop losses. And liquidity is completely all over the chart. And the market needs liquidity as fuel to be able to move from one particular point in price to the other. Because without liquidity, price won't be able to make massive moves, and that's why you see that most times you get stopped out right before the real move happens in the market. Why? Because price is just trying to generate liquidity, get enough fuel to move to his next point. So basically, most traders trading the market are just either buying or selling and exchanging orders. So we have buy limits, sell limits, buy stops, and sell stops all over the chart. And all these orders put together creates liquidity in the market. Now, most institutional traders, when they want to take their buy or sell trades, they look for pool of liquidity to be able to place trades in such a way that when they place their trades, it doesn't create too much friction that everyone knows exactly where they're trying to target and all of that. So when they want to place big orders, they need liquidity, and the best liquidity to use is retail traders. So your buy limits, sell limits, buy stops, sell stops, everything, market orders, liquidity. As long as you're buying or selling, you're adding liquidity to the market. And now you're going to see that I have liquidity everywhere, because for price to move from this point to this point, people actually bought right here, people actually sold right here. So there's liquidity here, 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 and liquidity here. There's liquidity every single where on the chart, because that's the only way that price is going to move. People are either buying or selling. Liquidity is on Asian highs and Asian lows, and liquidity is on each candle high and candle low. Now, the only important time-based liquidity you need to focus on, from my perspective, is the 4-hour time-based and then the daily time frame. Plus, you need to also focus on Asian range liquidity and London range liquidity. I'm a New York trader, so I'm mostly focused on Asian and London range. But if you're a London trader, all you need to focus on is Asian range liquidity, 4-hour liquidity, and daily time frame liquidity. So based on the fact that liquidity is everywhere on the chart, that's why we need to understand the different types of liquidity and only focus on important time-based liquidity. So for the purpose of this video, we are only going to be focusing on Asian range liquidity, London range liquidity, 4-hour liquidity, and daily time frame liquidity. So these are the liquidities that we want to see taken out before we place a trade. And no liquidity raid, then we don't even have a trade. So basically, it's time before price. Most people take it the opposite way. They just come into the chart, read it, structural liquidity, inducement liquidity, and all those different types of liquidity. But what are they really understanding what are they really doing, what types of liquidity are you looking for to be taken before you move with the market. Over the past few years, I've studied liquidity seriously, and I can tell you very well, and I can tell you for a fact that you need important time-based liquidity before you place a trade. And once you don't get a liquidity rate, you don't get a trade. So for the last time, you need a 4-hour candle high or a 4-hour candle low, which we have right here or right here. You need a previous daily high or a previous daily low right here and right here. And then you also need the Asian range liquidity and the London range liquidity if you're going to trade New York session. But if you're only in the London time zone, then you're only focused on Asian range liquidity because it's an important time-based liquidity. It's not just liquidity all over. There's liquidity literally everywhere on the charts. So we are only focusing on important time-based liquidity. So the first thing I'm going to show you is this. This is an Asian session range indicator that helps you mark out Asian liquidity and London liquidity. And all you need to do once you come to the charts is just check the daily time frame and also check the 4-hour time frame. And once you're on these time frames, you just want to easily focus on liquidity. So right here you can spot a liquidity rate. But when I come into the charts in the morning, this is what I do. I just come, mark out my fair value gaps. So since we understand that without a liquidity rate, we can't place a trade because price needs fuel to move in its intended direction. So it's just like, for example, take your car. You can move from this location to, probably you're going out with your friends. You can move to the other location without fuel or gas in your car. So take liquidity as the same exact thing. For price action to move on the charts, it needs fuel. So you need to first buy fuel before you move. Now, all you're doing as a trader is waiting for price to come to your fair value gaps. And once price is on your fair value gaps, you're looking for fuel. You're looking for the market to take fuel first before the trade. So as a trader, you need to be extremely patient because once price comes into your fair value gaps, you need to wait for fuel to be generated and taken before you now move in line with the trade. So on this chart, I'm going to show you a trade that I took on GBP USD on Wednesday. This is the 22nd of October, and this is very, very recent. And it was a 1 hit 1 kill. Now this is the 4-hour time frame, and price came into this fair value gap at 1 a.m. So a 4-hour candle basically means 1 2 3 4, and at 5 a.m. the new candle opened and swept the previous 4-hour candle liquidity on the fair value gap. And this is why I'm saying you need to be very, very patient. So for me, it's easier because I'm trading the New York time zone, and by the time I'm coming to the chart around 7 a.m., all this liquidity has been created, and I'm just looking and just waiting for a little bit of time for them to be taken. So I'm basically just trying to take the 9 a.m. candle basically, and you can see this 9 a.m. candle expansion, and all I needed to do on this day was just come into the market, and I saw that price was already on the fair value gap. Price has already swept the previous 4-hour candle low now, and all I needed to do was drop down to the 15 minutes candle or the 5 minutes time frame and look for important time-based liquidity in terms of London and Asian range liquidity. Now this is Asian range liquidity and this is London range liquidity. So as a New York trader, all I needed to do was just look at price from here. I saw this very beautiful market structure shift on this zone right there on the 5 minutes, 15 minutes, because you never go below the 5 minutes. So once you see a market structure shift on the 5 minutes, 15 minutes time frame, bro, there's nothing to think about. That's your trade. Look at this. This is a clear and beautiful example of what how liquidity and fair value gaps can be joined together to create a perfect setup for you. And you don't need to be like a machine gun in the market. All you need to do is wait with precision and act as a sniper in the market, waiting patiently for price to come to your fair value gap, waiting patiently for liquidity to be generated and taken, and then you trade alongside it. So you can see this. We have London range liquidity taken. We also have 4-hour candle liquidity taken. Those are two important time-based liquidity that were taken from the market. All you need to do now is just mark out your point of interest, place your trade, basically. And this would have given you a 124.28 risk to reward on a Wednesday. You probably don't even need to trade for the rest of the week. But I know a lot of you still want to trade again, right? You think the market is yet to give. But literally, this is how you can easily act as a sniper in the market without being everywhere and just taking important trades and waiting for the perfect time to execute your trades. Basically, so liquidity is everywhere, like I said, but you're basically just focusing on this liquidity, important time-based liquidity, because important time-based liquidity is the only thing that separates liquidity, original liquidity, from other types of liquidity, basically. So important time-based liquidity, it's time, then price, not price and time. You wait for the perfect time when liquidity has been generated and taken, and then you look at the price and execute. This trade, for example, on the 21st of October, this is on Tuesday, right? And this is on USD card, and that's USD Canadian dollar. So all you needed to do on Tuesday was look at this. But this is the structure. We are in a bullish structure. We mark with a Fibonacci from year to year, and you can click this out for now because that's a daily fair value gap. But if you even if you focus only on the 4-hour time frame fair value gaps, you'll still be able to come out profitable in the market, because all you need to do is just look at this bullish structure and understand that this is a premium zone, this is a discount zone. We are only willing to sell at a premium and we're only willing to buy in a discount. Now, what we are looking for is fair value gaps on the premium zone if we're going to sell, and all we're looking for is a fair value gap on a discount zone if we're going to buy. You can't be buying, it's not possible. Common logic tells you prices on the premium zone, I'm only willing to sell, and the only thing I need to do is just wait patiently for liquidity to be taken, and then you see a market structure shift on at least the 5-minute time frame. Bro, take your sell. And if you took this sell on Tuesday, which is just 21st of this month, you'd easily bank you'd easily have been able to bank 1 to 3, 1 to 4 on this particular trade right here, just by using this simple concept. And it happens every single fucking time. You're seeing it, 4-hour fair value gap, liquidity raid, and that's your trade. 4-hour fair value gap, daily fair value gap, 4-hour candle high sweep, or daily lows and high sweep. That's your trade. All you're looking for is just going to the lower time frame on the 5 minutes or 15 minutes and then taking your trades, basically. So it's just like money is resting. So it's like liquidity is money everywhere on the market, and all you're looking to do is just wait for liquidity to be swept. And if you even see right here on the higher time frame, on the daily time frame, you see that on this Tuesday that we had this trade, price still went to take out the previous daily high. So if price has taken the previous daily high on the daily time frame, and prices on the 4-hour fair value gap, bearish fair value gap right here, and then price has still taken Asian ring liquidity, I mean, there's nothing to think about than to just place your trade. So basically, liquidity is everywhere in the market, but you don't want to focus on all the liquidity in the market. You just want to focus on important time-based liquidity. Liquidity is everywhere. You always want to wait for important time-based liquidity. You're looking at important time-based liquidity, because liquidity is everywhere on the chart. And if you're also looking at structural liquidity, this could also come out to be your structural liquidity at some point, because Asian range is mostly consolidation. And then once Asian high or Asian low is being taken out on a specific zone, you wait for a market structure shift on the 5 or 15 minutes. There you go. That's your trade. Now that you understand how liquidity really moves the market and how to spot smart money traps, go check my previous video on fair value gaps. It's to show you exactly how both concepts connect. And if you got any questions, drop them down in the comments. I read and reply to every single comment. And if this video really gave you a new perspective, please like, subscribe, and turn on the notifications so you don't miss out on my next video. And if you're truly serious about fast tracking and mastering the skill set, click on the link below to get the free mini course and join the exchange program, where you're going to get a personalized coaching and real strategies that actually work. Remember, stay disciplined and stay consistent, and I'll see you in the next video. Bye for now.